We ran a quick analysis. So Serena, why don't you share with everyone on the different costs based on credit scores?
Yeah, so we just did an analysis on conventional cash out refinance scenario. This would give somebody somewhere in the neighborhood of $80,000 cash out in this scenario. So it's an $800,000 value with a $480,000 loan. I guess I didn't put that in there, 400 grand in equity. So, or something.
Well, that'd be $320,000 in equity.
Okay, 320 grand in equity, right? So basically, if your FICO score is at 650, in order for you to get that loan, your rate would be at 6.875. If you have a 700 FICO score, the rate goes down to 6.5. And then if you have a 750 or plus FICO score, you're at a 6.375 rate. So those rates maybe don't look so dramatically different, but when you pencil those out over time, it's a huge difference.
Well, and see, here's the other thing. If we're at 620, 600, 580, and so on.
Right.
Yeah, and we have a lot of clients that we deal with that have FICO scores all the way down into the 450 range. When you get below 6, one of two things happens. Either one, the cost of your interest goes through the roof. I mean, it gets crazy expensive, or two, you simply can't even get the loan. So the cost of financing becomes very expensive. So a lot of you that are looking at this going, what about me? I'm at 620 or I'm at 580. We have an enormous number of clients that are 500 something FICO scores. And the point I want to make you aware of is that if you're a 550, 580 FICO score, your interest rate on this is going to be much higher than this. It could be 2% higher than these kind of rates, depending on, again, the type of finance. And that's on real estate related, which is the cheapest financing you can get. But when you go into unsecured, that's where you end up with a 35% type of interest. And or they flat out can't even get you they won't even provide you the financing. So credit score is a big deal, and there are strategies, and I'm going to show you how we can really improve your credit score without spending money.
We should also point out, this is not a new first mortgage. So this is not a second mortgage, a second lien. And we're in a situation right now where this is really unappealing to a lot of people, depending upon what your interest rate is currently on your first. So this is the best case scenario, right?
Yes.